In our current market, the Feds have responded in a clear and concise manner by sending the signal to investors that these banks will not be allowed to fail. Feds have pumped more liquidity into the market by accepting a broader base of assets, including mortgages, in exchange for capital. They've reduced interest rates, and in the case of Bear Stearns, they even provided a financial backstop to J.P. Morgan Chase to encourage the transaction. These moves by the Fed are leading investors to feeling more confident about returning to the fixed income market. That's what's going to help this problem, is the signs that the Feds are sending to some of our investors, that they're not going to let this problem get to so bad. The secondary market for commercial mortgages remains quite volatile, and interest rates fluctuate daily as market sentiment continuously changes. There is an available market for CMBS loans, but spreads are stubbornly high. So just to give you an idea where spreads are in the marketplace right now, spreads on CMBS loans are right around 400 basis points over the 10-year Treasury. So this morning when I looked at 10-year Treasury, it was at about 4%. So you add 400 bips to that and you're at about 8%. I don't know. You can talk to Dr. Shadid after this meeting, but I don't think he would have did a conduit loan if it was going to be at 8%. It's an extremely complicated process. And the only reason why he wanted to do it was because the money was cheaper. And the money was cheaper, then that encouraged him to do it. But if the money's at 8% and he had to go through the same process that he had to go through to get the money, he's not going to be encouraged to do so. So now, just to give you a comparison, at about this same time last year, I was working on his deal. Remember, I quoted his deal at 120 basis points over the 10-year Treasury. So right there, you can see the difference. I mean, we're at 400 now. It was at 120 a year ago. If you wanted to look at insurance capital money, their money's trading at about 300 basis points over the corresponding Treasury. Once again, that's better than conduit money, right? It's 100 basis points cheaper. But it's still dramatically different in comparison to last year. They were at about 150 to 200 this same time last year. Agency lenders are trading their money probably right around 300 basis points over the Treasury as well. And agencies, meaning Fannie Mae, Freddie Mac, and even HUD, were probably right about 200 basis points this same time last year. So you've obviously seen those guys move out a whole point. I'll make mention for a lot of you guys, because I know a lot of you guys own multifamily property. Fannie Mae and some of your agency lenders have really stepped up in a major way to plug the hole in the market. Fannie Mae will be the dominant lender. Fannie Mae and Freddie Mac will be the dominant providers of multifamily mortgages this year. And that is a dramatic change in comparison to previous years. Last year in the CMBS market alone, we did $230 billion in loans. $230 billion. This year we'll probably only do about $100 billion. So we've actually seen our production drop off, more than 50% year over year. Some of the underwriting on commercial mortgages, and this is what you hear mostly, underwriting on mortgages have changed dramatically. We've obviously reduced loan proceeds to borrowers, so there's no more of the coming in and getting the 90 or even 95% leverage in order to buy apartments. That's gone away. We used to actually underwrite loans based on future cash flow. So you could come in, Jason could come to me and say, Algenon, I'm going to buy a set of apartments. The rents are at $600 right now, but I'm going to get it up to $675. Will you just underwrite to whatever my future effective gross income is going to be? Well, we would do that in the past, and that would actually net more loan dollars out to a person like Jason so that he could acquire the property. But nowadays, it's based on current cash flow. If your property's not cash flowing, then we can't do a deal with you. And also, requests for mortgages to be amortized over 30 years. A lot of those are being knocked down to 25 years now. A lot of lenders don't want to do the 30-year amortization money. And no more interest only. If you are getting interest only, then you're definitely doing an agency deal with Fannie Mae or Freddie Mac. And they're probably only giving you about 2 or 3 years interest only. At one point in time, we were actually giving people 10 years interest only. And then you just had a balloon due at the end of the 10 years. And a higher debt service coverage requirement. So we want to see more cash flow for every dollar of debt that you're putting on the property. Cap rates. Cap rates on properties have probably risen a half point to a full point, depending on if you have an A-class property, B-class property, or C-class property, and depending on your location of the property as well. And a lot of that obviously has to do with the higher cost of capital. It's becoming harder for people to get capital, so it's being harder for people to actually buy properties, and that's causing cap rates to actually come back up a little bit. Multifamily has definitely, and I've told Jason this several times, multifamily is definitely the property of choice right now. It is recession-proof. It's typically viewed as recession-proof. But we do perceive there will be some possible weakness in the multifamily market here in the Triad, and that may come from overbuilding. There's probably about 5,500 units planned here in the Triad, and that will probably do good for the current demand. But if we see too many more units coming in the pipeline, I do think you will have some overbuilding here in the Triad. For any of you that own property types outside of multifamily retail, definitely wouldn't want to be in the retail game right now. Consumer demand is off tremendously. The only type of retail properties I would want to own is grocery store anchored retail property. Grocery stores are typically recession proof and they can withstand a downturn. Hospitality is softening as a result of slower demand, and obviously gas prices shooting up. People aren't driving around as much. Business travelers aren't going out as much. So obviously the hotel sector is experiencing some weakness. Industrial remains stable. A lot of our export growth has been able to offset some of the declines that we've seen in imports. Obviously our currency is very cheap right now, so we're exporting a lot of products, and obviously those products still need to be staged and need industrial warehouse space and that type of thing. And our office market is probably moderate or stable here nationally, but considerably weak here in the Triad. And that's as a result of slow job development. We just aren't doing a good enough job of creating jobs here in the Triad area. And it's also a result of what we call legacy assets. We have a lot of legacy assets in the Triad, which means we have a lot of older buildings. And most of those buildings will not get rented out. They need to be probably pushed over. But what happens in the current market when you have those buildings sitting vacant, they actually throw off the market a little bit. It makes it look like we have a higher vacancy than we actually do. I'm originally from Winston-Salem. We have a lot of legacy assets in Winston-Salem from our old tobacco days. So that makes our vacancy look a lot higher in the Winston-Salem market. So that's the current realities. What I want to end on is, what do I believe the future outlook is? And I stress, what do I believe the future outlook is? Because if I knew for certain, I probably would be on Wall Street right now trading futures or doing something fun like that. The economy has not technically reached recession levels, but the consumer is definitely in recession. By technical definition, we have not experienced even 1 month of contraction and growth. Obviously, a recession is defined by 6 months of contraction and growth. So technically, we have not reached a recession, but our consumers are definitely in recession. I mean, they're obviously getting hit by rising job losses. They're getting hit by higher energy costs. And obviously consumer demand is starting to weaken because of that, and the housing market is sapping a lot of demand out. Consumer demand is still somewhat stable, even, and it's remained stable even at the outset of the housing crisis, because consumption does not typically move with asset growth, and that's a common misconception. People think consumption moves with asset growth. It does not. Consumption actually moves with wage and salary growth. As we see contraction in wages and salaries, then we'll see consumption start to fall off as well. We are starting to see some contraction in wages and salaries. I would expect to see some contraction in consumption. Right now, our current unemployment rate is at 5.5%. That's the big headline right now, and that's supposed to send the signal that our economy is slowing down. But when you look back in history, 5.5% is about the average unemployment rate even for an expanding economy here in the United States. So what you got to keep in mind is our unemployment rate, which was about 5% or below for a good couple of years, that was abnormally tight. So us rising up to 5.5%, it's not good to hear that unemployment is going up, but it's definitely not the end of the world. The economy will benefit from a shrinking trade deficit as a result of export growth. We think that will happen over the next several years. And obviously, we believe consumers will start to save more because of what's happening in the economy. We had a personal savings rate that was negative here in our country. And we need our consumers to save more money, and they will start to save more money because prices do change behavior. And we will see more foreign direct investment here in America because of a weak currency. So we are already seeing more people from overseas come over and want to buy property, even here in the Triad. There was an Italian group that's been looking at properties here. We know there's a German group that's been looking at properties. And we've even had communication with an Israeli group that was looking at properties here in the Triad. That is a direct result of a cheap currency and them able to buy properties a lot cheaper here. Institutional investors such as pension funds, insurance companies, private equity, and endowments, they will continue to be net buyers of real estate. They will not stop acquiring real estate, even in a downturn. They do not believe their allocation to real estate is adequate. You got to keep in mind, real estate just came online as a mainstream asset class in the last few years. So a lot of these large institutions still want to grow their allocation to real estate. So we expect them to continue to buy even with the market tightening. And the other thing to keep in mind with the large institutional investors, they don't need credit. They don't typically need a lot of debt to buy property because they use a lot of cash. A lot of these large REITs and a lot of these pension funds, typically only maintain very low debt, very low loan to values ratios on their portfolios. I met a group out in California. I mean, you look at their portfolio, their loan to value is less than 25% because they use a lot of cash when they go to buy properties. The weak currency will keep oil prices high, so I expect to see rising interest rates in the coming quarters. If you've been watching the news, our Federal Reserve has finally taken notice to the fact that the oil prices are through the roof, and that is a direct result of speculation, which is a direct result of weak currency here in the United States of America. They do have to do something to strengthen currency. They cannot let our currency continue to erode the way it has. The way you strengthen currency is you raise interest rates. I expect that to happen. When it happens, I'm not quite sure, of course, but I do expect interest rates to go up in order to get our currency back to some kind of an equilibrium.